Traders, I'm looking at the pound Kiwi. Let's just go out to a daily and I'll show you what I'm looking at. Now, I've had somebody request that I explain in more simple terms the concepts that I usually talk about with my videos. I think some people are finding my videos a little bit difficult to follow. Right, so for the benefit of anyone who's new to trading, I'm going to explain, how I'm seeing the markets and hopefully give you a better understanding of how the markets are moving and, I'm going to try to simplify some concepts that could be a little bit complicated. So, and look, what I'm sharing here are not my concepts, right? My ideas basically are my interpretation of courses, of mentors that I've had in the past, of teachings that I've been involved with from other people, right? So I'm basically passing on my version of what I've learned from others, basically. Right, so looking at this, we've got a few things going on with this chart. We had a data release earlier today, and we have this spike in the market. The data release was the Reserve Bank, New Zealand Reserve Bank, discussing or releasing data on interest rates, and it was more dovish than expected. And dovish data release in relation to interest rate will cause the market to rally, right? So it's for the New Zealand, it weakens the Kiwi currency. So we see now the pound Kiwi pushing up. There's a few things going on here. We've got this red candle, and when you look at this area down in here, this is an accumulation range for big money. Right? They buy up down here. So let's just mark that up as a, as green as a support level. But more importantly, this is where big money accumulates. And the news release, happens, but the thing, my understanding with this is the algos will price this up. And obviously the market will follow, okay? We'll get people piling in here long. But what's going on here is two things. Well, firstly, this area here above this daily high is an area of high liquidity, right? It's a liquidity pool. And so what we have resting up here are buy stops prior to this bearish expansion or this move to the downside. So the buy stops that are sitting up in here are a target for big money, right? Now the algos push or price it up into this area. I don't believe that it's trader volume that's moving this. I believe the algos price it in here. They want this to trade in here so that they can pair their orders, possibly for a retrace down into here, right, to pick up more liquidity and push it up. Now, other targets, well, the draw on liquidity would be here and then finally up in here. Okay, so it's a bullish trend here, and we have two targets that are viable, right, for this thing to reach for. Okay, so this then is going to look for two things. It's already hit buy side liquidity, and that should cause this to retrace into sell side liquidity. In other words, the stop losses that are resting all through here on the back of this bullish run, this move. So we have stops resting under here that are a target. Given that this has soaked up this liquidity most likely, well and truly, this should range here and then it should pull back. I mean, they could price it further up if they want to hit these stops. That's a possibility as well. So, it could be a shallow pullback and it moves higher. But at some stage, expect a pretty decent pullback. And look, after a news event, when it moves like this, I'm always expecting the pullback, the retrace. Now, the liquidity sitting under here, that's a target. The other thing that we have here is on the 4-hour time frame. So let's just point the arrow to that, and we'll go back down. So we've got these levels marked up as a potential target, profit targets, right? So we're going to go down to the 4-hour time frame. And anywhere you see the market ranging, it's either accumulation or distribution, right? Down here, it's an accumulation range. Big money accumulates, and then the market trades, pushes on, right? So what we have here, have a look at this thin candle, this green candle here. What I've done is I've marked up the candle on the left, the high, and the low on the candle on the right. So we've got a bullish imbalance. It's one-way trading more or less here, okay? So there's a bullish imbalance that could be a target for this to trade back down into and reach into. So let's just mark this up with a middle line, something like that. And this midline coincides with this level through here. Let's just mark that up. Okay, so we got, well, back through here and through here. So we got this level through here. So, I mean, it doesn't have to push all the way through to this green zone to rebalance, right? So it could possibly, touch it, move into it, into the mid, the midway, the mid-level point, possibly, when we get something like that. So that's that. Okay, so the market looks to hit liquidity under here in the form of sell stops and rebalances, right? The other thing that the rule of thumb that I have with a trend is, generally speaking, I'm looking for a pullback into, look at this here, for example, low to high. So we have this price swing, low to high retrace, at least into the 50% of the previous price swing. Think about big money. They're going to be looking to buy at a discount, and the discount would be around this 50% level and under. Okay, so the range below 50%. So I've got on my fib here marked up, if we pull the Fibonacci from low to high, the red zone here you can see is my threshold. Right, so I would prefer to get involved with this if this pushes down into my Fibonacci zone, right? So if we pull the Fibonacci from this low now up to this high, the 50% and 61.8 on the Fibonacci coincides beautifully with this imbalance. Right, so that would be an ideal. You could speculate with a limit buy down in here, something like that. There's one target. Stop below the low if you want to play it safe, or below the imbalance. But you could go below this low price swing. And here we have a 1.6, and up here to this second level we've got a 2.3 R. Okay, risk reward 2.3. You're risking 1 to make 2. So it's a 2R target, or in this case 2.3. What else can I say? That's the thing. So, you can either speculate with a limit buy in here, or you can be in front of the charts and wait for price action to, if it, into the maybe the US Open or something like that. It might trade back down in here, and if it does, then you could follow it and wait for the opportunity to get in on the rotation as this rotated and this rotated. Okay, so it pulls back, and you look at it this from maybe a 5-minute or a 3-minute chart, and you look for price to shift gears on the lower time frame. In other words, it breaks market structure. Okay, so we can have a look at that quickly. Go down to a 15. Excuse me. Now this is an example here if you're looking at market structure. So on the, even a 5-minute chart would be good, but see how this is trending down on the 15M more or less here like so. Well, the break of market structure occurs, the first break is this one here. That would be a change in character, chock. Change in character of this downtrend. And, you know, it really broke structure back in here. This high. That was the break of market structure in my opinion. So at that point we're looking for the pullback to get long. So you could trail it on a 5-minute chart, but you know, wait for this. And the other way to look at it is to mark up the range. You know, it trades down and it ranges sideways, and then you know when the high of the range is broken, then it's an opportunity to get involved, right? This one was pretty sudden. There was no real opportunity there. It just took off with a vengeance. But here, right, again, you can speculate with a limit, a bit more risk involved, or you can wait for price to possibly, you know, it does something like that, dips down under here to take out these lows. It ranges and then wait for maybe a little bit of a shakeout, a fake out perhaps. That's in a perfect day. That's going to happen. But sometimes it doesn't play out quite like that. But look for the range and then the bit of volatility. This would generally draw buyers in. And the idea of that is more stops get placed, will get placed underneath. So it builds a liquidity pool under. So let's just mark that up and call it that, liquidity, right? So the first movement would be, in terms of price action, this push up, more stops go under here, and then they hit those stops. Right, so you could look for this price action. And then the range, wherever it happens, is going to be something like that. Mark it up, right? So there's your break of market structure. And then you get an opportunity on the retest and fail of this range, all right? So I would look for something like that. Back down in this within this imbalance, this thin candle here, you can see that. It's also the imbalance on this time frame as well. So that's my approach, guys, with the pound Kiwi. Speculate with a limit buy if you like, a higher risk, or you just sit and wait. And this will play out either the London Open or most likely, you know, later on into the New York Open. And if it trades back down and we see it rotate around the New York Open like this, then you know, that could be an opportunity. So I hope I've explained this and you understand the concepts. Trying to keep it simple, but that's a very simple explanation of how, you know, the markets kind of work. Okay, guys, look, with that, I'd love you to hear your comments. So definitely leave a comment below. And with that, safe trading, and we'll see you in the next video.